This move follows 3G Capital's 9.4 billion buyout of Skechers and signals further consolidation in the global sports retail and sneaker market. There are a couple of signals that these acquisitions are pointing to. First and foremost, that brick-and-mortar retail is under pressure, brands are regaining power, and scale, reach, and experience are becoming key differentiators. Let's look at all the strategic implications in detail. First and foremost, the vertical consolidation in the sports retail. Now, Dick's is a dominant US sports retailer with strong control over its in-store experience and private label brands. Acquiring Footlocker gives it access to a global footprint because Footlocker has 2,400 stores across 26 countries, and exclusive sneaker access and streetwear clout via brands like Nike, Adidas, and Puma, and an urban and youth-oriented consumer base that complements Dick's suburban family shopper. The implication here is that Dick's can become both a lifestyle and a performance retail powerhouse, controlling more of the sneaker and the streetwear value chain. The second implication is the international expansion almost overnight. Dick's is predominantly US focused. Footlocker's presence in Europe and other international markets instantly gives Dick's a distribution as well as a brand recognition boost outside of US. The implication is that the deal becomes an entry ramp for Dick's global ambitions without really building international infrastructure from scratch. The third implication is in real estate and experience strategy. Footlocker's mall-based store fleet is very different from Dick's House of Sport experiential mega stores. The implication being that there is a potential dual retail strategy, using Footlocker as the fast fashion or sneaker drop outlet while positioning Dick's for an experience-driven, high-margin flagship environments. But store overlap and cost-cutting will likely follow. This brings us to the brand relationship reset. Now, Footlocker has been working to win back key brands like Adidas after losing exclusivity deals. Meanwhile, Dick's has cultivated partnerships through omnichannel integration and data. The implication here being that combined, they could offer the brands a more powerful retail partner and also have more bargaining power, especially with brands like Nike, which have been recalibrating its whole wholesale partnerships. This also leads us to think if this is a defensive play amidst weaker consumer spending. With US consumer demand under pressure, consolidation offers an efficiency play and stronger pricing leverage across marketing, supply chain, and operations. The implication being that this is much more of a defensive play than an offensive play, controlling more shelf space as discretionary spending slows and tariffs slow. And lastly, let's talk about the response to the private equity activity. The recent 9.4 billion acquisition of Skechers by 3G Capital signals rising interest in athletic and lifestyle retail.